Okay, so this is a basically an article review from Second Skies Forex, right? I believe it is the website of Chris Capri, right? I find that this article actually has brought in quite a bit of debate in this trading sphere. So I would like to actually give my own 2 cents into what I think about this trading article. So this article is called Five Reasons Why Hedge Funds Earn Trading Confirmation Price Action Signals. So let's have a look at this, alright? So if you want to see, right, you just go down to his website, secondskiesforex.com, and I think you can just, Google search this title of this article. You should probably see this on the, on the search engine. So the first thing he talk about is basically, in essence, he's saying that, why trading pin bars, engulfing pattern, right? Pin bars, engulfing pattern, fakey false breakout setup is basically is inferior compared to someone who trades reading the raw price section of the markets. So he lead off with the first example showing that I believe, if I'm not wrong, this chart is from Nell Fuller from learntotradethemarkets.com. This is basically him showing you that there is a potential pin slash fakey buy signal in anticipation of higher prices. And then he mentioned what happened after this fakey pin bar signal happened is that price basically, smashed lower. So needless to say, this is definitely, I won't say definitely, probably a losing trade, depending how you manage your trades, right? Chances are it will be a losing trade. So this chart over here, right, what I'm thinking is that, it honestly don't really mean a thing, right? Trading, if you have been doing this for a while now, you know that trading is dealing with probabilities, right? You're dealing with the law of large number. In the short run, right, your trading results are basically random, and only in the long run would your age, right, play out in the long run. So by showing a single chart of a losing trade, to me, it's basically, pointless, right? Because another trader could just as well cherry pick a very similar setup and show that it's a winning trade. So how do you actually, conclude whether this particular pattern works or not, right? So charts really don't prove anything at all. So if really, I think a better way to go about this is to, use number and stats, right? I mean, if you're a trader and you're thinking whether should you wait for confirmation pattern, or should you just, trade using a raw price action approach, let the numbers tell you, whether, which approach is better instead of, just one or two charts. Because as I mentioned, one or two charts isn't really going to prove a point, because in the short run, your trading results are just basically random, right? Due to the law of large number. Okay, so this over here is, to me, it's something that can't really make a point at all. So, okay, then after which you talk about the first reason why hedge funds, they don't wait for confirmation price action signals, and it's because they pay 5 to 6 figures to train their traders. Okay, so hedge funds, the first reason is because they pay 5 to 6 figures to train their traders. And what's interesting is that I see this photo below, and it's from SMB Trading. So it's basically, this isn't a hedge fund, this is a proprietary trading firm. So I'm thinking whether, why it's a little bit a mismatch over here. I think what is more appropriate is to be instead put a picture of a trader in a hedge fund, looking at charts, instead of someone from a prop trading firm. So nonetheless, right, then after that he goes on to say that bank traders make on average to 2 to 4,000 trades before they can trade the bank's money. So what I'm curious is that, let's say a trader have to make 2 to 4,000 trades before they can trade the bank's money. So while you are doing these 2 to 4,000 trades, right, whose money are you trading? Is it demo trading, or is it, I don't know, paper trading? Before you can trade the bank's money, how are you even going to execute this 2 to 4,000 trades if it's paper trading? Because bank traders, right, first and foremost, their priority is to be a market maker, to provide liquidity to the institutions all around. For example, here's what I mean, right? For example, if I'm Bank A, right, and there's this, say for example, this institution, right? Institution. Did I spell this correctly? Institution, right? Say institution B, right, wants to buy, say for example, 1 yard of euro dollar. So 1 yard is basically 1 billion notional value of euro dollars. So you go and get a quote from Bank A. So if I'm the dealer at Bank A, I am supposed to fill this order for this institution B. That is my primary role, right? This first and foremost, this is my primary role, because I'm a bank dealer. I make the market. So I'm thinking, right, I'm thinking, how do you actually, paper trade 2 to 4,000 dealing trades with, institutions in real time before you can trade the bank's money? Because this isn't a, looking at a chart and placing buy and sell order. This is a market making role where you're supposed to fill orders from different institutions in real time, whether you want to hedge the position or whether you want to take the entire counterparty risk, or hedge it across the different banks that you have connections with. So this is something that is really interesting, this statement, because I have no idea what he mean by you have to trade an average of 2 to 4,000 trades before you can trade the bank's money. Okay, so hedge funds also spend large amounts of money either training or finding talented traders. Yeah, there is some truth to this, because hedge funds they can really spend money to actually groom their traders. So reason 2 is macro plus technical. So okay, he mentioned that in this article, this book review he did, is that this sociologist followed the forex traders at a top 10 German bank desk for over a year. So never once were the word pinbar engulfing pattern were mentioned in the book. So basically, he implies that bank traders, they focus a lot on macro and technical, and this is something I agree with, because my brother used to work for a local bank in Singapore, and they focus a lot on macro and technical as well, to give him a feel of how the market sentiment is like, to then make decisions whether he wants to take the risk of the order that comes in, or whether he want to hedge it, and stuff like that. So this actually perhaps plays a part into managing the so-called the book of the bank. So, and of course, the reason why you don't get the word pinbar engulfing pattern and stuff like that from traders in the bank, because as I've mentioned earlier, right, bank traders primarily, they are, I think a better term is bank dealers. They are basically market makers. They provide liquidity to the markets, to the institutions, to other hedge funds out there. So that is their primary role. So needless to say, you won't be, hearing these terms from them, because they are not retail traders or traders who are, who are trading directionally in the market, trying to make a profit to earn their living, right? They are first and foremost, primarily, number one, market makers. Okay, so reason 3, confirmation decreases accuracy and profitability. So basically, I believe in this video, he's illustrating again why if you wait for confirmation, it decreases profitability and accuracy. And again, right, this again brings us back to the earlier example of using charts, is that you can just simply cherry pick examples to prove your case, and another trader could just cherry pick examples to prove their case. So it's basically, this is subjective, right? There is no way to prove it by using just charts that are all based on hindsight, because it just doesn't make sense. Again, like I've said, a better way is to use math and stat to prove it, right? And adding on to this, right, what I want to share is that I do know of traders, professional traders, successful traders, who actually trade using a variation of a pin bar, right? They use a different term, right? For example, I can name you one. How about this person called Victor Sperendio, right? I hope I pronounced his name right. He wrote a book called Methods of a Wall Street Master. This book came out in 1993, and he actually talked about a pattern that is very similar to this, the pin bar that it's used by price action traders these days, right? He coined it a different term. I think was it the island reversal and stuff like that. But the concept is essentially very similar, right? Second one, you can look at the Martin J. Pring, right? He wrote a book called Pring on Price Patterns, and I think he coined the term called the Pinocchio bar, right? So I think he is possibly one of the founders, of trading this kind of pin bar, right? He called it the Pinocchio bar. The third one you have is, who else? How about this? Tom Williams, right? He's basically, I think, the founder of the volume spread analysis. He calls it the spring, right? The spring, basically, another variation of the pin bar. Again, very similar concept. And in more recent times, how about Adam Grimes, right? I really like him because he wrote the book called The Art and Science of Technical Analysis, right? For him, he coined the term failure test, swing failure test, right? And what I really like about him is that he used math and stats, right, to actually prove that the swing failure test, which is just basically a variation of this pin bar, actually provides an edge in the markets mathematically, right? He shows the table of the test that he has done, and he proved that he actually has an edge in the market. So this is something that I think is really worth looking at, right? The works of Adam Grimes, because there is math and stats to actually back up his findings. So yeah, you can see that these 4 traders over here basically have traded a very similar method, like the pin bar or engulfing pattern, right? This Victor Sperendio, Martin J. Pring, Tom Williams, Adam Grimes. So I can't really say that, waiting for pin bar and stuff is a retail entry method, because these are all very renowned traders, basically like, pioneers of our time, who actually trades in this kind of a variation. Not exactly the pin bar, but it's a very close variation. If you want to learn more, you just go Amazon, check out these traders, their books and their works, and you can see what I mean. So I can't really agree that confirmation decreases accuracy and profitability, because there are other traders out there who are just as successful, right, trading in this similar manner, right? But one thing I want to point out is that I believe that the pin bar or engulfing pattern or whatever candlestick pattern is not their only setup, right? I believe they have a variation of trading setup, and this is just possibly just one of the tool in their toolbox, right? So this is something to think about. The fourth thing he mentioned, that waiting for confirmation price action signal is passive trading. So passive trading, so I'm guessing passive trading you mean by it's more relaxed, more laid back, because you are just watching and waiting for something to happen. And yeah, okay. So if they were to be doing this consistently, they'd be picked off by HFTs or predatorial funds who could see their entries a mile away. Alright, maybe I just want to share a little bit about predatorial funds or high frequency trading firms. So first and foremost, right, they don't really target retail traders, because retail traders is too small. So how they operate, right, is like this. For example, there is this HFT fund, say HFT Fund A, right? So what they do is they typically front run the orders of the bigger funds like hedge funds. So for example, hedge funds B, let's say hedge fund B, right? So let's say, for example, there is this exchange over here, right? Hedge fund B want to buy, say, 1 million shares of Apple. So what happens that HFT, they are smaller than hedge funds B, right? They are small in size. So once you are smaller, you can be faster than this bigger, larger, cumbersome hedge funds. So once they know that this hedge fund B wants to get 1 million shares of, say, Apple in the exchange, right? They would actually, front run the order. So what I mean by this is that, for example, Apple is trading at $100, right? Once they know that there is this big order coming in, they'll quickly hit the offers, and price of Apple will say, for example, goes up to 105, right? So they go long at 100 and now it's at 105. So needless to say, from 101, 102, 103, 104, this HFT firm A will be buying at these prices. So once this 1 million share comes in to buy at Apple, hits the market, from 105 is going up to, say, for example, 120, right? So what happens is that this HFT A, they go long from 100 to 105, and they can sell it off at 120. Okay? So they make the difference of, for example, say, in this case, say $15, right? Just a hypothetical example. So this is definitely unfair to this hedge fund B, because instead of going long at $100, this firm over here has basically front run their order, got in at 105, and they're paying, in other words, $5 more per share of Apple. So this is basically how HFT or predatorial funds work. They target the big hedge funds, right? The really big funds that actually put in large orders in the market, and this is how they they sort of pick off their nickels and cents each time, right? Of course, $5 is probably a very exaggerated example, but it's just to illustrate my point. So HFTs typically target these big hedge funds and not retail traders, because retail traders, they are just a very small fraction in the liquidity in the market, so it's really not worth their time pursuing retail traders. And then the Pepsi challenge, then he says that let's say the above 4 reasons didn't convince you. We can simplify this using a very simple test. So the test is that you can either walk to a dozen or 2 hedge fund office, bank trading desks, and prop firms and ask them these 2 simple questions. If you don't see the daily pin bar, engulfing pattern, or inside bar, are you staying out of the market? First question. Second question is, if you do see a daily pin bar, engulfing pattern, or inside bar, are you loading up on your position even more than usual? So, okay. So to answer this question, right, first and foremost, right, you have to understand what is the role of these 3 different entities: the hedge funds, the bank traders, and the prop traders, right? Let's talk about hedge funds, right? Hedge fund. What is a hedge fund, right? I think it's very simple. If you use hedge fund, basically takes in clients' money, and they use that money to generate a positive return for their clients. So hedge funds are large, right? They are typically the market, right? You have funds ranging from a few hundred million to even billion of dollars, right? So needless to say, a hedge fund will not be able to trade this kind of a daily inside bar, daily pin bar and stuff like that. For example, let me illustrate my point. Let's say you have a $1 billion hedge fund. Let's say on the excuse me. Let's say on this, say for example, this is the chart of euro dollar, and on the 5 minutes time frame, you have this pin bar over here, a bearish pin bar, you want to sell. So say from this sell entry to this high over here is maybe it's 10 pips. Okay, so you have a hedge fund. Your net asset value is $1 billion. And say you follow the typical retail risk management, you risk 1% on your trade. So 1%, right, in notional value, you are looking at $10 million risk on each trade. So $10 million risk on each trade, and having a 10 pip stop loss on this pin bar on this euro dollar chart. So what does that translate? You know that euro dollar is $10 per pip, right? So in other words, you're looking to short a million euro dollar contracts to keep your risk 1% of this $1 billion. So if you look at this pin bar, you sell $1 million of euro dollar contract. What's going to happen to the market? Right? Of course, it's going to collapse, right? Yeah, it's going to collapse because this would have moved the markets. Right? Because think about this. You are selling 1 million euro dollar contracts. 1 million. That is, I think, easily is going to, smash the price. I think easily a few hundred pips or even 1,000 pips based on this simple 5 minutes bearish pin bar. And so this is precisely the reason why hedge funds, they can't trade in this manner. Their size don't allow them. They are Goliath, right? David and Goliath, they are Goliath. Their size have limitations on them. So they, of course, adopt different approach to trade the markets, right? Perhaps using macro, using fundamentals, or, trend following and whatnot. So that's it. The second thing to look at is bank traders. So bank traders over here, you see bank trading there. So as I mentioned, right, traders in the bank, first and foremost, their primary role is market making, to provide liquidity in the market to institutions, to hedge funds, and whatnot. So if you're a market maker, you need to pay attention to the order flow that's coming. For example, someone wants to buy 500 million worth of the pound dollar or stuff like that. So you have to decide on the spot whether you want to take the order, whether you want to hedge the order, and stuff like that. So basically, you're just very in tune to the order flow that's coming in. So how you actually going to base your decision is actually based on perhaps see how exposed you are in your book. What is the sentiment like in the economy, the macro perspective? So needless to say, you also won't be using pin bar and engulfing pattern and stuff like that, because your role primarily is market making. And what about prop trading firms, right? So prop trading firms, I believe you can find prop traders who actually trade this pin bar and engulfing patterns, because prop trading firms, what they are is basically they don't have any clients involved. Let's say, for example, I'm someone who has, say, $10 million. I have $10 million, right? I've traded successfully and I have about $10 million in my pocket. I don't want to trade so actively, so maybe I hire, say, another 5 traders to trade my money, right? So I give them each, maybe say 500,000 each to trade my money. So you can see that, they are not really big in terms whereby big until they start moving the markets, right? They are just basically, I would say, a form of retail trading, but more professional with better equipment and better access to the exchange, right? This is what basically prop trading is all about. So yeah, they definitely can trade this kind of, candlestick patterns, right? Because they will not be moving the markets, right? So he says that, I'm willing to bet the answers above will be a resounding no. I would say no to both bank traders and the hedge funds, but a possibly yes to both prop trading firms, right? So you get several laugh again. Again, I think there's no point talking about this. So yeah, there you have it, right? Basically, this article, right? 5 reasons why hedge funds aren't trading confirmation price action signals. I hope this let you really think deeper into what trading is all about. And I think it's a very good point to illustrate is that in trading there is a lot of information out there, and some of it could be outright false, some of them could be real stuff, and some of them could be written by traders who don't really know what they're talking about. And the thing about you reading this, right? I'm not saying this article is nonsense or anything, but rather I think the key message to bring across is that whatever you read on the internet, right? Whether is it from my own website or other website, right? Even my own website, right? You want to take everything with a pinch of salt. Okay, this is important, right? Because nobody cares about your money more than you do, right? And the only way to validate the findings that you have read online is to test it out yourself, right? Nobody's going to do all this hard work for you, right? So only you yourself have to do it, right? So this is basically the message that I'm trying to bring across, right? And this article over here, I'm just sharing with you my own insight into what I think about the 5 reasons why hedge funds aren't trading confirmation price action signals. Okay, so with that, right, I hope if it helps you, right, or in any way, right, you can feel free to leave a comment section below and let me know your thoughts. So with that, I wish you good luck and good trading. Talk to you soon.